Hey, what's up everybody? Welcome back to my channel. So today we're going to be doing another stock analysis video, and we're going to be looking at a company called OpenText. So this is another very large Canadian software company, and it kind of continues the theme we've been doing lately on this channel of looking in depth at some of the bigger Canadian software companies. So we looked at Shopify, we looked at Lightspeed, we also looked at Nuvei, but this video is going to be a little different because in my previous videos what I like to do was look at the balance sheet, look at the income statement, and also looked at potential growth catalysts for those companies. But because this is a more mature company, I'm just going to focus on 7 years of historical financial information. So we're going to look at that, we're going to analyze that, see if it tells us a story about this company, and then use that financial information to project future cash flows going out 5 years, and then try and determine an intrinsic value for this business, and then compare that to the current stock price to see how undervalued or overvalued this company potentially is. But before I get into any of that, if you are new to my channel, I would greatly appreciate it if you would consider subscribing to my channel. I created this channel recently with the goal of just providing average, unbiased information to the retail investors out there and just the investing public at large. And my goal is to hit 100 subscribers by the end of this year. So if you could help me achieve that goal, I would greatly appreciate it. But without further ado, we'll actually get into the video now, and we're going to start off by looking at some of this company's actual valuation metrics in Morningstar, just to kind of set the tone for this video. Okay, so here I have Morningstar pulled up for this company OpenText, and I'd highly recommend Morningstar, especially for the beginner investors out there who just kind of want general information on a company's financial metrics. But I want to direct your attention to here, so the price to earnings ratio. And it kind of shows how it's evolved over time, which I think is really useful information to look at, because not a lot of financial websites will provide that. Usually they'll just show what it is currently, but as we can see, it's kind of fluctuated a lot. Now a lot of this, these example here, this will depend on the company's actual earnings. They had some large tax write-off, which is why it was so low here. But we could see in 2018, 2019, it was about 36, and then it increased drastically. So going into 2020, it was about 47, and now it stands at 91. So obviously this company has become a lot more expensive relative to earnings. But if we look here down at price to cash flow, we can see a lot more reasonable valuation metric, and one that has actually increased. If we look at the current one here of 16 versus just under 12 here, it has increased, but historically, if we go back to 2017 at 21, it's relatively cheaper now. So this kind of proves that you don't always want to look at a price to earnings ratio solely, and then if it's too high, just automatically dismiss the company, because sometimes there's more to it than just the earnings, because as we know, earnings can be manipulated in many different ways. But anyways, I'm going to show you my financial model now, and we'll actually go through the intrinsic value calculation for this company. Okay, so what I have here is 7 years worth of historical data of selected financial information for OpenText. Now keep in mind, it is a Canadian company, but all these numbers are in millions of US dollars. And they have a year end of June 30th, 2020, which is actually ending very soon. I'm filming this video in late June of 2020. So we can kind of project what their revenues will be, because we do have 3 quarters of financial information already. But just looking historically, we can see 2014 they had 1.6 billion in revenue, and then 2020, so this was June 30th of 2020, that's now grown to 3.1. So this gives us a compound annual growth rate throughout this time of just over 9%, so 9.7%. And we can see it's been kind of erratic, but mostly stable growth. So it was down this year here very slightly, and it didn't increase much here. But then we do have these kind of certain periods here where it does grow quite a bit. We have double-digit growth rates here. So overall, just under 10% annual growth rate, which is a good sign to see. You obviously want to be investing in companies that have this type of top-line growth. And then in terms of gross profit, their gross profit margin has been very consistent, around 68 to 66% range. So that's a good sign. And then specifically, we also want to look at EBITDA. So with EBITDA, ideally for a software company, you want to see margin expansion as the company grows and matures. And that's what we see here. So their EBITDA margin, 2014 was about 25.6%. And we can see a fairly stable growth rate kind of throughout the years here. Then it gets to the point where it's just under 36%. So again, a very good sign there. It just shows that they have the ability to expand their margin as the company grows and scales up. So now moving down, I've done an EV/EBITDA multiple calculation here. So back in 2014, it was about 20.4, and it's gone down since then. So now we can kind of see there's a big decline here, and it's kind of gone down a bit more over the years, and it has an average of 14.5. as we can see here. But that average of 14.5 is kind of skewed because of this 20.4. I think if we are to look at a reasonable EV/EBITDA multiple going forward, it makes more sense to kind of use these averages here. Another thing to point out is their debt has actually gone up quite a bit. So about 1.3 billion in 2014, and we fast forward to 2020, about 4.2 billion. So they are kind of erratic in how they may make, one year there may be a large issuance of debt, and then next year maybe a large repayment of debt. So that's one thing to keep in mind with this business. And then I just did a basic free cash flow calculation here. Now, one thing to keep in mind with this free cash flow calculation is that normally when you're calculating free cash flow that's available to equity holders specifically, you want to take into account any debt that they issue and then any debt that they repay kind of on an annual basis. But because with this company, it is very erratic in how much debt they issue one year versus how much debt they pay back the next year, I kind of just wanted to focus on a basic free cash flow calculation to focus on the business specifically. And not really have the numbers that are influenced too much by what they choose to do with their capital structure by issuing or repaying debt. So for the sake of this model and just keeping things simple, I am just going to focus on free cash flow as it's kind of simplistically defined as just cash flow from operations minus capital expenditures. So if we look at how their free cash flow has kind of grown throughout the years, it's grown went through about 375 million here to 888 million there, so about 13% annual growth rate, which is pretty much aligned with what the growth rate in EBITDA was. So it was a bit smaller here, so 15% there, but it did grow at a rate that's faster than revenue. So that's a good sign to see. And then cash flow from operations, and we compared that to capital expenditures. We could see their capital expenditures are pretty stable. So 73 million with just under $1 billion in cash flow from operations. So 73 million in CapEx, and then 42 million in CapEx back in 2014. And then it's been pretty stable at around 70. There's this one-off year here of 105. But that's a good sign to see. And you kind of see that with software companies, typically a very low CapEx. And then what I like to do when projecting free cash flow is kind of look at it as a percentage of figures that are a bit more easier to estimate. So we can look at free cash flow as a percentage of revenue. And we can see it has been fairly stable. So 23%, 24, 25, 15. This one's a bit lower here. And then it's gone up a bit in these recent years here to about 28%. So an average of 23%. And then we can also look at free cash flow as a percentage of EBITDA, which is what I personally like to use. So we can see it was a bit higher in these years here, almost 90%. It then went down in this one year. They had some type of one-off expense in this year, I believe. And then it's grown a bit, back up to about 75, 78% there. So it has an average of about 73%. So free cash flow as a percentage of EBITDA, usually around 73%. And then shares outstanding, they have been gradually issuing shares. So each year it's grown at a rate of about 1.7%. So nothing really to worry about that much, but over time that could have a large impact as an equity holder if you do continue to get diluted like that. And because it is growing at a stable rate, I think it makes sense in our projection to assume that it is going to continue to grow at a similar rate. Okay, so now if we move on to the actual forecast period. So I have a 5-year forecast period here. So 2021, which this cash flow here I haven't actually discounted because we're assuming this is taking place in June 30th of 2021, which we're almost at that date now because that's when this company's year end is. So 2022 will be discounted 1 year, and then 2025 discounted 4 years. But I basically just assumed that their revenue is going to grow at a fairly stable rate. So as we saw previously, their revenue was growing at about it grew at 9% back going to 2014. I think it's safe to assume that it can grow at a fairly similar rate, just based on growth in this industry and what you'd expect a company like this to be able to achieve. And then EBITDA. So as we looked at previously, the EBITDA margin was somewhere around 35. I believe it was slightly higher if we looked at it as an average. So we can just put at 35%. If they do achieve an EBITDA margin that is higher than 35%, we could just leave that as potential upside. So just keeping EBITDA as a stable percentage of revenue. And then we can look at free cash flow. So free cash flow is determined by taking it as a percentage of EBITDA. So it averaged somewhere around 73%. So for the purposes of this model, we can just assume that it stays pretty flat as 73% of EBITDA going forward. And then we get these free cash flow numbers here. So free cash flow For the next 5 years, highlighted in green here is our free cash flow stream, and then we also have to do the terminal value, obviously, because that makes up a much larger portion of the total cash flows that we're projecting. So the way I got this was just by taking their terminal year EBITDA, so the 2025 EBITDA number here, and then multiplying it by 13.5, which was historically about what we were expecting this company to achieve in terms of an EV/EBITDA margin based on the numbers I showed here, which I think it's safe to assume that historical data will dictate what this company's number will be like going forward, just given they have been growing at a fairly stable, consistent rate for most of their company's history, going back 7 years. So if we're just making a forecast based on reasonable assumptions, I think it's safe to assume these things here. So like I said, highlighted in green is our stream of cash flows that we're projecting. So really the whole point of what I want this model to show is we looked at historical data and we got an idea of certain metrics, right? So we know how much their revenue's been growing, what their EBITDA margin is, what their EV/EBITDA multiple has been in the past few years, and then their free cash flow as a percentage of that EBITDA. So then we want to use those numbers, which we have historical data on, and just assume that they're about what the average has been over the last 7 years and project that out 5 years. Now, obviously, they're not going to stick to what those numbers are exactly, so the projections are going to be wrong. I'm not trying to predict the future to see exactly what this company will do, but the whole point is, what is reasonable for this company to grow at? You know, what are reasonable expectations based on what they've done in the past and what we could expect them to do in the future? We don't want to make too erratic growth projections because then we might just get disappointed, but we don't want to be too conservative as well because then we're not being fair to the company and what growth potential they might have. So the next thing I'm going to do is show you the actual intrinsic value calculation that I've come up with, and then we'll see relatively how undervalued or overvalued this business is. Okay, so this box here has the intrinsic value number. So it's super simplistic. Basically, you have your terminal year free cash flow, which would be this item here, which we calculated as 13.5 EV/EBITDA margin on their terminal year EBITDA, which is this number here. And then we discount this to the present, all right? So assuming that it is June 30th, 2021, which it will be very soon. So we get this number here, and then we have the present value of their cash flows from 2021 to 2025, which is this here. So we have a stream of cash flows that is these here plus this. Now I've used a discount rate of 12.5%. And so with this 12.5% discount rate, the reason I have that is that's just my required rate of return. So that's what I would like to see an investment have before I even consider any further. So I didn't use the capital asset pricing model to determine it, which is a pretty typical method. It's when you look at the risk-free rate, the company's beta, the market risk premium to determine what type of a discount rate you would have. But I think it's important to use your required rate of return because when you invest in an individual company, you're exposing yourself to the risk associated with that company versus if you just invest in the stock market as a whole, you're only facing systematic risk. But with individual companies, you have unsystematic risk. So because you're taking on more risk, you need a higher reward in compensation for that risk. So we know the market typically does about 10% a year if you look at a 40-year average history. So I just added a slight premium to that to kind of compensate for that additional unsystematic risk we're taking. So if you're a bit more risk averse, maybe you'd want to take a higher discount rate. 15% is a common one to use just kind of as a baseline. But again, that's kind of the methodology I had behind 12.5% in case you're wondering. Okay, but let's continue with the intrinsic value calculation. So 12.5% discount rate. So when we discount these cash flows here and we sum them, we get an intrinsic value of about 18 billion here. And then on a per share basis, so I divided this by the shares outstanding we would expect this company to have into the year 2025. So I just assumed shares outstanding would grow slightly as we've seen them in the past, so about 1% a year. So 273 million here to 285 million there. So then we get an intrinsic value per share. This is in USD of 63.79. Now you can currently purchase these shares in USD on the stock market for about $52. So based on these projections, this would lead us to believe that this company is currently undervalued by about 18.5%. So does this mean, because we've identified that possibly this company is undervalued, that you should just drop whatever you're doing and go buy as much of the stock as you possibly can and remortgage your house so you can buy OpenText stock? No, obviously not. Because you do have to build in a sufficient margin of safety when you're investing in individual companies especially, because you don't know what's going to happen in the future, right? We tried to make reasonable projections based on historical data about this company and what their free cash flow will be, what their shares outstanding will be, and then just kind of used a reasonable discount rate based on what we're looking for. So 12.5%, which is our required rate of return. But obviously those projections are going to be wrong, right? We don't know what's going to happen in the future. They could lose money in the future years. There could be something new that happens in the software business. We just don't know. So in order to protect yourself and put yourself in a good position when you're investing, is you want to have sufficient margin of safety, which means buying at a discount below your calculated intrinsic value that's sufficient that even if they don't hit those lofty growth expectations or even moderate growth expectations, which is what we did here, then you're still going to be okay. Because you don't want to put yourself in a situation where the company needs to just blow it out of the water and go to the moon in order for you to earn a decent return on your investment. You want to put yourself in a good position where even if they don't grow super fast, your investment's still going to do okay. And so that's what I've done down here. You can see if you're looking for a 20% margin of safety, well, the company's pretty close to that right now. They only need to drop in price at about 1.8% in order for you to get that 20% margin of safety. But usually you're going to be looking for a lot more than that. Obviously, the higher the margin of safety, the more likely you are to invest in a company like this. And when you do kind of calculate companies' intrinsic value, the best companies you'll find are the ones that have the highest margin of safety. That's how you really know you found a good investment that is potentially significantly undervalued. So say if you wanted a 50% margin of safety, the share price is going to have to fall quite a bit, maybe 40% almost. But usually most investors will be satisfied with about a 25% margin of safety. It all just depends on what you're comfortable with when you're investing in an individual company and putting your money at risk of that company's management team and the industry they operate in, all that type of stuff. So if you want a 25% margin of safety, the stock price would have to fall to about just under $48 in USD, or down about 8% from where it's at right now. So the whole point of this is to give you an idea of how much does the stock price need to decrease by in order to obtain certain levels of margin of safety, which is ideally what you're looking for. Okay, so now that we've gone over their historical data, we've done an actual projection and tried to calculate intrinsic value based on reasonable assumptions, we've looked at margin of safety, you can kind of see now the point of this video, right? The whole point of this video was to show you that just don't be discouraged by companies that have a super high PE, because there's often more to the story, right? As an investor, your goal is to focus on free cash flow. That's really how you get paid back. That's where your value comes from in a business. And you want to buy with a sufficient margin of safety, as we've seen here. Because this company, based on the projections we did, yeah, it was slightly undervalued, but as we know, our projections could be dead wrong, and we just don't know what the future's going to hold. So this is a company that I'm definitely going to have my eye on in the coming weeks and months. If they do drop below to a level where I could get a 25% margin of safety, then I think it does make sense to allocate a small percentage of your portfolio into this company and kind of get some additional exposure into the software industry. Again, that's just my opinion, that's my thoughts based on this analysis that I performed. Obviously, some people are going to disagree with it. They may think I was being too conservative or may think I was being too aggressive. The whole point is just to look at a valuation model like this and intrinsic value and kind of see what happens when you look at certain assumptions. The assumptions I used were just based purely on historical data, right? I wasn't assuming any drastic changes in the business. I was just assuming it's going to remain stable, which it's obviously not, right? We know things are going to change drastically, but all we can do is make reasonable projections and then see what kind of a margin of safety we can get in depending on what level we buy into a company at. But anyways, that's all from me, guys. So thank you so much for sticking around and listening to my analysis. If you did enjoy this video, I'd appreciate it if you would leave a like and subscribe if you're new, and I'll see you in the next video.